Welcome to the Schork Group's presentation, The State of the Energy Market. We here at the Schork Group are committed to supporting the energy market participants through the COVID-19 crisis. We invite you to contact us directly with questions specific to your trading needs. I'm Stephen Schork, principal of the Schork Group, a research and advisory firm that provides fundamental and quantitative analysis of the energy markets, with special emphasis on the impact of geopolitics on price volatility. What is the U.S.'s role in the current bear market for oil? In February, the United States sanctioned Russia's largest oil company and its trading arm, thereby hampering the company, Rosneft's, ability to trade oil around the globe. At the time of these sanctions, the United States was by far the largest crude oil producer in the world, producing a record 13.1 million barrels a day. In addition to producing a record amount of crude oil in the first half of March, the United States was also a net exporter in 6 out of every 7 weeks since October, and that is a net exporter of oil, both crude oil and petroleum products. So now, if you're Russia, you've looked at the United States that has just sanctioned your largest oil trading company, therefore hampering your ability to compete on the global export market. At the same time, United States exports of crude oil were beginning to ramp up. So clearly, with the United States producing a record amount of oil, exporting that oil, and then sanctioning Russia, Russia really had no alternative but to decline an invitation by Saudi Arabia back in early March to cut its own production. The bottom line here is the United States' decision to sanction Rosneft in February was the antecedent for the current price war between Saudi Arabia and Russia. Unfortunately, this price war now is juxtaposed against a hit in economic activity around the world that has sent oil prices spiraling lower. Government-mandated shut-ins to economic activity around the world is now exacerbating the overproduction that we're seeing both in the United States, Saudi Arabia, and Russia. Here in the United States, we will make no bones about it. We are in a depression, not a recession, but a depression. When we look at the last 4 weeks of first-time unemployment insurance claims, more than 22 million jobs in the United States have evaporated. According to the latest monthly numbers from the Bureau of Labor Statistics, those on the bottom of the income scale are suffering the worst. If we look at this chart, workers in the leisure and hospitality industry, those are restaurant workers, bartenders, waiters, waitresses, so forth. People who in 2019 on average earned $429 a week. These are the ones that saw the largest hit in job losses back in March. 459,000 of the 713,000 jobs that were lost. When you look at the bottom 1/3 of earners, and that is everyone from leisure and hospitality up to education and health services at $912 a week. The job losses in those 4 industries at the bottom of the income ladder accounted for 6 out of every 7 jobs that were lost in the month of March. According to a back-of-the-envelope estimate from an economist from the Federal Reserve Bank of St. Louis, estimates are that by the end of the second quarter, the number of unemployed persons in the United States will be above 52 million people. Already we know that 22 million people have lost their jobs over the last 4 weeks. So between now and the end of June, upwards of another 30 million Americans could be unemployed. So when we take the potential of 53 million people unemployed and we go off of the civilian labor force rate in February of 2020 of 164.5 million Americans in the labor force, we're looking at a potential unemployment rate of 32%. But let's be clear, we'll probably never get to 32%. Why? Because that civilian labor force rate will continue to decline. Already in the numbers for March, that number dropped by 1.6 million. Therefore, The headline number for March was an increase in the unemployment rate from 3.5% to 4.4%. But really, because those 1.6 million people dropped out of the labor force, they weren't counted as being unemployed. Had they remained, the unemployment rate in the United States today is actually 5.4%. That was in March. When we take into account what we've seen in the weekly numbers since then the unemployment rate currently today, assuming all metrics remain the same, is actually 11%. Bottom line is tens of millions of Americans more will probably lose their jobs. More will drop out of the labor force, thereby keeping the unemployment rate artificially low. But the bottom line here is the United States economy has never seen a drop in employment in such a short period of time. So what does this mean for energy demand? Well, looking at the data from the latest US Census, 76% of workers who commute by car. So already with 22 million people out of the labor workforce, that means more than 15 million people are not driving to work. If we get to 53 million people by the end of June, then upwards of 40 million people will not be commuting to work. More importantly, the governments still have the economy shut in. So even the people that are still fortunate to have jobs will most likely still be working for homes, i.e. not driving to work. So we are going into the summer where we normally get a pop in demand, people driving to the beach, driving to the lakes, driving to the mountains. With 53 million people economically depressed, that is not going to happen. More importantly, when we have 40 million people who are not driving to work, we are looking at a significant hit to demand in gasoline for this summer. The bottom line is the summer demand season is dead on arrival. The lack of demand in gasoline can be encapsulated in this one picture. On the bottom left in the black, we have a market that looks like a normal commodity market. That is to say, this is the differential, the price differential between NYMEX RBOB gasoline, which is delivered into New York Harbor, against NYMEX WTI crude oil, which is delivered into Cushing, Oklahoma. So clearly, this isn't a real quote-unquote crack, but it does give you an overall picture of the psychology behind refining economics. Now, back in February, J20 is the April 2020 contract, RBOB over the corresponding WTI contract. April is the first 9-pound RVP contract, i.e. the first summer grade contract. And it was trading at a $20.80 per barrel premium to WTI. Very normal. More importantly, the market as we went through the summer strip, K20, which is May, all the way out to Q20 on the bottom right, which was at a $16.85 premium per barrel over WTI. That is what a normal, healthy commodity market looks like. Backwardated market during the peak seasonal demand season. If we looked at where we were the third week of March, every contract on the NYMEX for RBOB gasoline traded at a discount to WTI, beginning with the April contract at a $2.58 discount to WTI, all the way out to the August contract, which traded at a 69-cent per barrel discount to WTI. In other words, there is not a refinery out there that would look to maximize production, obviously, when you're getting less for what you're churning out than what you're buying, putting into the tea kettle. Since RBOB went negative back in March against WTI, prices have rebounded, but not significantly. That is to say, the summer strip is still trading in the low single digits against WTI. Therefore, refineries have no option but to minimize their operations, thereby minimizing their purchases of oil through the peak summer gasoline season. As of April 10th, refinery operations were already below 70% of capacity. Given the current economics, we could expect muted demand for crude oil throughout this summer, thereby setting the table for prices to be lower for longer. So as demand continues to decay through the summer, you have an inversion in the forward curve in pricing. Instead of being in a normal, healthy, backwardated market where prices this month are greater than prices next month, we are in a severe contango where prices this month relative to next month, 6 months from now, 12 months from now, are trading at a significant discount in the spot market, i.e. a super contango. Therefore, it makes more sense to buy oil today and deliver it into tank and sell out the futures market, thereby assuring tankage going to near capacity. So the question is, how quickly can we get to capacity? At the current rate of demand decay and overproduction, the NYMEX storage complex for crude oil in Cushing, with a working storage capacity of approximately 76 million barrels of storage, could be at capacity by the end of May. So now we have this scenario where we are producing too much, we are not consuming nearly enough, and we're running out of places to store oil. Once again, setting the stage for lower prices for much longer than what many in the market currently are anticipating. Here is a picture of the collapse in the term structure that I just mentioned. Again, back in January, we were looking at a healthy market, and this is in the ICE Brent crude oil market, where the June contract, that is M20 at $62.90, was trading at a 70-cent premium to the contract for July delivery. And as we moved out along the x-axis, the price of Brent continued to fall. So we were in a normal, healthy, backwardated market. The red line, or the y-axis on the right hand of your screen in red, clearly shows the super contango, where the June contract traded at a 24 or nearly a $3.25 discount to the July contract. And in fact, today, if you have available storage capacity, you could buy oil in the nearby markets, sell it out 6, 9, 12 months out, and net a 20, 30, 40% premium. A market that is paying you a 40% premium to store oil is the greatest telltale of the most bearish fundamental out there. There is no demand, and the market is expecting that to last throughout the summer. This could not be a more bearish picture going into the peak summer demand season. So a quick recap. The United States is currently producing too much oil. We are not consuming nearly enough oil, and we're not going to be able to export our way out of this situation. Here we're looking at the collapse in the differential in Brent WTI. Back in February, Brent was trading at a $4.49 premium to WTI, which historically has been a very normal rate, all the way out through the October contract, which is V20, trading at a $4.40 premium. At the start of this month, Brent has collapsed relative to WTI, with the June now trading at only $1 premium to WTI, out through October, $3.33. So again, through the summer, the collapse of the Brent WTI spread is telling us that U.S. indexed oil is less competitive now in the global market, with the collapse in Brent prices, which are a marker for the global price. So consumers are going to look to buy Brent indexed oil relative to WTI indexed oil, thereby exacerbating the glut as the United States is no longer to compete internationally on the global markets. So what is the outcome? What does this mean for pricing? Who are the likely winners and who are the likely losers? Just to jump ahead, there are no winners, but there will be a lot of losers. Here are the results of a survey conducted by the Dallas Federal Reserve through the 11th Federal District Bank System. That is the state of Texas, part of Louisiana, part of New Mexico, i.e. the oil patch. And when asked, 153 executives at E&P firms and oil and gas service companies, what price do they need to see to cover their existing operating costs on existing wells You went as low as $23 a barrel in the Eagle Ford, $26 through the Permian, $28 in Bakken, up through $36 for U.S. non-shale. When the Dallas Fed asked these executives at what price do you need to see a new oil well drilled, they ranged again from $46 a barrel in the Permian up through $52 through the Delaware Basin in the Permian. The bottom line here is oil prices are nowhere near, not even covering the operating cost of existing wells, let alone drilling for new oil. So clearly, we're in the midst of seeing a massive pullback in U.S. production. On Monday, April 20th, that was the penultimate session for the contract on the NYMEX for May WTI. On the Friday before, we settled at over $18 a barrel. At its lowest low point on the 20th, the May contract traded at a $40 negative price, meaning that the producer would have to pay the customer more than $40 a barrel to take the oil away from them. It does not get any more bearish than that. This is in the futures market. We're already seeing significant discounts on oil for landlocked basins in the Dakotas up through the Saskatchewan plain for heavier sour crudes. Even condensates now up in Edmonton are trading negative. If you're landlocked, you do not have enough storage, and you're running out of pipeline capacity, you're still set the scenario for lower prices for much longer than anticipated originally. It can go without saying that we've never seen negative prices on the NYMEX before. Before April 20th of this year, the previous low print occurred in April 1986 at $9.75. At minus $40.32, that is by far unprecedented. But it is also clear that someone large in this market blew up on the 20th. We don't know yet who it was, but someone came in to April 20th of this year owning too much May WTI. And they were made to pay the ultimate price. It remains to be seen. But that does not mean the current bear market has run its course. We perhaps will not get to negative prices again because the market is prepared for it. But as we've seen already, it's possible. And for the reasons we've laid out in this presentation, with the inversion of the forward curve and what that means to the capacity constraints to storage in the United States and beyond, our inability to export our way out of this market, the fact that on July 1st, perhaps as many as 40 million Americans will not be driving to work, and those who do have jobs will still be working from home. In other words, we are not going to have any demand for gas this summer. For those reasons, we are looking at and we remain pessimistic on any significant rebound. So on April 20th, the June contract, which is the next contract that goes spot, was trading at around $20 a barrel. We would not be surprised to see the June contract trade in the single digits, and it's a potential that the June contract could go negative as well. This, ladies and gentlemen, is a bear market, and we still have a long road to hoe. So the losers. Here's the outcome of the Dallas Fed survey. When asked the E&P industry and the oil and gas industry, their outlook for employee retention by the end of December 20th. Now, bear in mind, this survey was conducted between March 11th and March 19th. And you already had a significant amount of companies, more than 20%, that expected to see a significant decrease in employment. And then you had about 30% of the respondents who expected to see a slight decrease. Now, keep in mind, when the executives from these companies were answering these questions, oil was still $40 a barrel. To this point, the other question posed by the Dallas Fed, if the WTI price of oil were to fall below $40 a barrel and stay there, how long would you expect your firm to remain solvent? 15% of firms said they would not stay in business beyond a year in an oil environment below $40 a barrel. Nearly 25% said they could last perhaps upwards of 2 years. On April 20th, oil traded not only below $40 a barrel, it traded below $0 a barrel, as we've said. So the significant pullback in producer output in the months ahead will be monumental. In closing, for the reasons laid out, too much production, not enough demand, no exports, no storage capacity, sets the stage for significantly lower prices in the months ahead. It is not until we get these government-mandated contraction to the economy and we're all allowed out of house arrest and we start to see activity come back into the market that we can start to become optimistic. Unfortunately, in the here and the now, we still remain pessimistic on the nearby future in crude oil prices. Therefore, we repeat that the Schork Group is committed to supporting everyone in this market to get through this crisis. We invite everyone listening to contact us directly with questions related to your own trading and hedging activities. Take care and good luck.